Is now the time to buy an investment property in Australia in September 2023? Guys, my name's Julian. I'm the head of strategy at Ripe House Advisory. Let's get into some of the key details we want to cover off today. What we are seeing at the moment is an extreme, resurgence in consumer confidence. There are kind of three key drivers which drive property pricing. The first one being is demand there? The second one being supply, and we can touch on that in a moment. And then the third one being confidence, which is very rarely talked about, in investment circles. When we talk about firstly in the supply side of things, we have had for the best part of 4 years now an absolute slowdown in the building construction industry. We've had lockdowns, we've had, queues when it comes to waiting for materials. Has been up to 2 years plus in terms of waiting for builds, and there's been just a reduction of stock coming into market off the back of no new stock coming into market means there's no newer stock or old stock to put onto market for sale. So we've also seen a massive reductions of listings of properties coming through, and then off the back of that, confidence really took a hit over the past 12 to 18 months. And what are the key kind of drivers on that? So firstly, we can talk about interest rates. It's no surprise that we went through an unprecedented rise of interest rates over the last 12 to 18 months. If we kind of go back further, though, if we go back to, say, 2004 time period, we can see interest rates were actually kind of more at their kind of average mark around that kind of 5 to 5.5%. GFC kicks in and we see the interest rates go to a much higher level, a lot of 7-8% mark. We then have the GFC hit, and then in that same time period, as we can see here, confidence was going up at a very high level. Confidence retracts, and not only does it retracts quite quickly. And that confidence is what we saw a big pullback in the property market here in Australia. It was around that kind of 7 to 8% mark, which on the scheme of things is actually pretty small. If we went to some other markets like the UK and the US, I believe they were close to double those numbers. So we didn't really get the kind of economic scale of impact here in Australia, some other markets. But what happened from then? So from then we had interest rate cuts. The construction industry took a hit there as well. We had some rises, but then again, we continue that trend of cutting rates. And we can see over that period of time as we continued to cut rates after we hit at that point was an historic low for consumer confidence. Confidence continued to grow through that period of time. And it's no surprise that as confidence went up, supply was already very short and continues to be short, because if you don't know, Australia is the number 2 population growth country in the world. Israel is number 1. So we've had prices more than double across the country in that period of time. But then we take a snapshot here to 2020, and what we can see in 2020, we can see a huge dip. Coincidentally, we actually correct lower post that dip than the GFC, but initially the pandemic hits. And the pandemic hits, we don't go lower than GFC then. We panic, people stop selling property, things go on pause. What happens from there is we get announcements by the government, we get JobKeeper, we get JobSeeker, we get Home Builder, the big home grant building stimulus package that was released, and also states, unlike Victoria, but other states started to open back up. And immediately we saw confidence pick back up. And that was at that time where we saw most of the market increase by 20 to 30%. So we already had supply and demand there, but we didn't have confidence. Confidence picks back up, prices start to pick back up. But then what happens? Then we get hit with inflation very hard. And what we need to understand about that inflation during that time period is that inflation was supply-led. So you've got two kinds of inflation. You've got supply-led inflation, which is essentially or the supply chain struggling to get access to materials. Or then you've got demand-led inflation, where demand-led inflation is people coming in, they're ordering things at higher volumes than ever before, and the supply chain can't keep up because of that. There's more demand than anticipated. What we've seen is essentially that supply start to catch up. So if you imagine there's a queue around the block, people waiting to get in, that queue has been getting longer and longer. And we saw the RBA announced last month that inflation has corrected quicker than anticipated. The American and the US markets are around 6 months ahead of our schedule, and they're correcting even faster. So don't be surprised if that keeps going on. And what people tend to forget is that before COVID kicked off, we were actually borderline in a deflationary period where we were heading towards, if we have a look here, we were actually heading towards negative interest rate territory. Some countries did have negative interest rates. We were nearly at zero in the cash rate. So people need to actually realize that once that supply chain has fully caught up, don't be surprised if and it's already being anticipated by a lot of the bank economists here in Australia, that they're anticipating rate cuts. I saw a leading economist in the US sector that they're anticipating rates to start with a 3 in the next 24 months. But regardless of that, what we can see here is we actually bottomed out in the market. If I choose to zoom in a little bit more, we'll shorten the time span here. When I zoom in to a shorter time period, we'll go towards the back end of last year. Around here, around September, October last year, is when the market actually bottomed out. And we saw that as an advisory part of the business, where our largest growth cycle came from clients who were buying around that September, October time, because what people were going through was that fear mentality. Confidence was going low as these interest rates continue to climb and climb and climb. But we actually had several more interest rate hikes since that September, October time. But what people realize is that those rate hikes weren't having this doom and gloom effect of their finances that was being reported in the media. This mortgage cliff, which was being, I guess, heavily pushed and still being pushed, wasn't happening. For point of reference, 0.3% of homes in Australia actually sell because of distressed sale, and majority of which come from drug and alcohol abuse. So the average person is not selling their property because they can't afford it, and over 96% of properties are at a positive equity point. So even if John Smith needs to stump up his property tomorrow, he's probably actually going to walk away with a tidy bit of profit. But what we're seeing here is confidence is increasing. And another kind of key indicator of where just the general market is heading is the auction clearance rate, particularly for your Melbourne and Sydney markets, because they can kind of tend to pull everything along with it. If we take a snapshot here to September 2022, we see Melbourne and Sydney were at just under 60%, which are considered quite poor in terms of properties clearing at auction. When a market's hot, we're looking more towards that mid to high 70s, sometimes even touching the 80s. Well, if we have a look here at the week result just gone, September 10 for last weekend, we can see Melbourne is at 71.5% and Sydney at 73.4%. So that to me is another key indicator that we are just at the start of another warming up cycle. I don't think we're anywhere near the top. That wouldn't surprise me if that comes towards spring next year. But what you are going to be highly likely to see as retail spend is starting to come down, because that's the first one to take a hit from these rising interest rates, is do not be surprised if come December we see our very first rate cut. Now, by no means are we going to go down at 0.5% or come down as quick as we went and we're going to go back down to zero rates, but don't be surprised if we see our first rate cut in December. And if it's not in December, I would almost put money on it today that it'll happen in February. Once that does happen, what you will find is that consumer confidence will continue to rise. And if we zoom out, because again, we always need to have a bit of a longer timeline when we're having a look at these kind of indicators, what we're going to see here is that we're still not anywhere near the top in terms of consumer confidence. So we've got supply, demand, and confidence. Confidence is only halfway there. Once we get back towards this 101 kind of mark here on the consumer confidence index, that's when you're going to know you're in a really hot market, but we are on the upward trend of the roller coaster. Guys, I hope that made sense to some of you. If it did, or if you did have some more questions, please feel free to leave me a comment below. And also make sure you're following me on LinkedIn. I'll be posting a lot more data-driven content on there for you to absorb as well. And we also have something very big coming in the next couple of months, which I'm really excited to share with you soon. Feel free to like and subscribe, and I'll catch you guys in the next one. Bye for now.